China preparing for a gold standard, or is China getting prepared for a gold standard? And they're two different things, right? Yeah. There's the idea that, well, the Chinese are going to make the yuan backed by gold. They're going to choose to put that gold standard in place there are multiple reasons why they might do that. I don't believe any of them hold water when you really look at them. Or are they making sure that if we reach the point where the world needs to go onto a gold standard, because of all the things we just discussed, they're in the strongest position? That makes much more sense.
Yeah, fair.
Right? Yeah. So, look, we don't know, but what we do know is the debt is unmanageable. We do know the numbers. We can see that the US is now spending $1.3 trillion on interest payments for the debt. And the CBO predicts that that's going to get to 2.1 trillion by 2036. They can't afford that, right? So we've reached the point where the system is unaffordable. And so we end up moving away from a place where they make choices about gold standards, and we've reached the point where they need to impose them because the system starts to buckle. And that's always been my contention. No one's going to choose a gold standard. But when things get to the extremes, you need to say, well, we need something. And gold is by far and away the most likely thing that will be put back at the center. Gold is always the answer, right? Because it's the only honest money. So it's always the answer. The difference is, for long periods of time, people don't want to ask the question. Yeah. Because everyone's happy the way things are. Let's not ask about what's honest money because we don't need to. You reach a point eventually where people start to say, well, actually, let's have this conversation. And people start to decide they don't want to use fiat currency. They don't want to use the dollar. They don't want to use whatever. So as you approach that point, the public, on the one hand, will want to save in dollars because they realize their purchasing power is going away. And at the central bank level, we've already seen that. We've already seen after the Russian central bank asset freeze in 2022, we've seen central banks grabbing gold hand over fist. And I showed the data in my presentation yesterday. So if you go back to the Weimar hyperinflation in Germany, and you look at what happened to the mark. Now, at the time, it was a fixed price, 475 gold marks for an ounce of gold. Germany goes off the gold standard because they need more money to finance the war in 1917. They bring in the paper mark, so there's no gold limit anymore. And originally, it's still pegged at 475. A year later, it was 1,400. 3 years later, it was like 3 trillion paper marks to an ounce of gold.
New paper, yeah.
Exactly. And we all know those stories about hyperinflation in Zimbabwe, and we all know those stories. And we've all seen the 30 trillion Zimbabwe note. We've all got one as a paperweight somewhere. And there's information in that. But if you go back to the gold price during that period, and you take the chart of the price of an ounce of gold in paper money, and it's just a hockey stick on a log scale, it goes off the top of the slide. But then you put the percentage change in gold in, and it does this. And so as that process went, gold would double in a month, go up 100% in a month, and then it would crash 20% the next month. And people would say, well, gold's in a bear market, it's down 20%. No, it's not. Yeah. And so this fixation with gold being in a bear market because the price fell 20%, this moved from, when I did the original presentation in 2018, gold was at $1,300 an ounce. It got to $5,500. It's now at $4,000 an ounce, right? In that time, the debt has doubled from 20 trillion to 39 trillion. And gold is up almost 3x. So gold is narrowing the gap. It's playing catch up, right? So all these things are happening, but they happen on a time scale that was 8 years ago I gave that presentation. Everybody is so focused on either the trading session or the week or the month or the quarter. No one's looking at decades and centuries, and that's gold's timeline, right? It's permanent money. So you have to try and find a new way to look at this that allows you to think in probable outcomes that aren't normal, because we haven't had to think about a gold standard for 60 years. But we're back there again now, and you need to think about it. So what does it look like? Well, I've laid it out in my presentation. There was a Morgan Stanley report released a couple of months ago, and they estimated, you're talking about family offices, they estimate the average individual investment portfolio in the United States has a 0.17% allocation to gold.
Is that it? Wow.
And they also said in the same report that every basis point increase would mean 1.4% move in the price of gold. So you can see how the gearing there is enormous because there's so little gold. And if you start to add it to portfolios, it will have a material effect on the price. But look, ultimately, I don't think that matters because gold has become a trading vehicle for a lot of people.
Yeah.
And I understand why, because everything is a trading vehicle, right? Even sports bets now, everything's a trading vehicle. Everything's a trade. Calcium, Polymarket, and all these things, they want you betting and trading on everything. But when the time comes, gold is not going to be a position to put on or a trade. It's going to be the solution to a problem. And when it becomes the solution to a problem, it's not about the price, it's about ownership. And the price takes care of itself. It's like, do you have any gold? Because you need some to solve this problem that your currency is going to zero. And if you don't have any, you need to get some. And it'll cost you more tomorrow than it's going to cost you today, so you better buy it today. And that's how these things ultimately go. You know, that's how you get to that acceleration stage at the end where people realize, okay, it's not, do I think gold's going to go from 4,000 to 5,000? It's, I need some gold. So if I need it, the price is, you know, if I need a ticket to the England-Norway quarterfinal, the price is the price, right?
So yeah.
It's just the way it is. We're not there yet, but we are heading towards that. And the speed at which we move towards that is only going to increase. And so for me, I can understand why people would hold it for the same reasons, but I think you'll sleep less and you'll have a lot more decisions to make because of its volatility. You know, I was talking yesterday to a group of people saying that, you know, if you're an investor, there are two prices that matter to you. The price you buy something and the price you sell something. And ironically, the price you buy it at is the most important of the two. If you're a trader, you have both those prices, but you have 100,000 prices you're quoted in between, and any one of them might matter to you, or multiple prices might matter to you. And gold has become the same. You know, there are a lot of prices that matter to people. Gold, it went through 2,000, went through 3,000, went through 4,000. It went through 5,000 like a hot knife through butter. And because it went from 5,500 back to 4,000, people have lost track of the fact that 4,000 was a pipe dream a year ago. And here we are. And they're all saying, is it over?
This is a classic case in point. So like this last week, we had some weaker than expected labor data from the US. That was bullish for gold, bearish for the dollar. So that's an example of what I mean by the markets pivoting back. You know, if the same kind of data came out when, you know, Trump was talking about complete obliteration and Stone Age and all that stuff, much less impactful. Like we saw this 2 months ago. When I said what a difference 2 months make, this is a case in point. So, yeah, it's interesting. But here's the thing. Like, there's a lot of hope that the inflation genie will go back in the bottle because, you know, the war is over, oil prices are down. But, of course, we know that, you know, well, let's put it this way. The actual inflation prints, the EU did see a cooler print, but the US prints have all still gone up. And even if they do come off a little bit because oil as one input went down over this month, the underlying inputs are still going upwards. The producer prices, and that's true in Europe and the US, are still going up. You know, the PPI in the US not yet passed on to consumers. You know, that gives, you know, I think any reasonable investor would look at that and say there's no reason to expect inflation to really go down from here. And maybe cool off a little bit, maybe go sideways a little bit, but we're by no means done. You know, the prices are still going up on the input side. So, you know, I guess the bad news is for monetary metals enthusiasts, gold and silver, is that you know, the market may be unpleasantly surprised by stickier for longer inflation, which ultimately is good for gold and silver, ultimately. But near term, that reaction function is still there, and we could see prices head lower. History doesn't repeat, but it can rhyme. And yes, I do see similarities. In fact, I'm not really a chartist, but if you superimposed January 2026 over September of 2011 on the gold chart, it is spooky how similar those are. And, you know, the good news is that was 2011. In 2012, gold went sideways for a while, but then it fell off a cliff, right? And we got a 4-year bear market. So I'm not predicting another bear market in gold, but I'm just saying to the degree that these charts echo, that's not a good thing. You know, it says, okay, over the next year, we might see correction and consolidation, but it says the next big move will be down, not up. My view as a fundamentalist is the opposite. And people call me names and get mad at me because I took profits. But my view is actually still that the next big move will be up. I could be wrong, but that is my base case. And so it is interesting to look at those charts. And we are actually right now at a point where if you superimpose the last three big peaks, 2011, 1980, and 2026, right now, the sell-off this year looks worse than 26, but better than 1980. But if it keeps going lower, it's going to be worse than both. And that would be pretty alarming. You know, even if I'm not a TA, you know. So just to be clear, dear audience, I'm not predicting a bear market. I'm not saying the next 4 years